Good evening. Today we're going to wrap up Chapter 8. We're going to talk about analytical procedures during the planning phase. As you go through this, do I need to remind you how important 315 is? If you have the full book, I suggest you read page 199 through 208, and I think it's Chapter 7. If you don't have the full book, that's okay, but I think those are 9 good pages. We're in the planning phase of the audit, and this is part of our risk assessment procedures. 315, assess the risk of material misstatement, understand the client's business industry, assess the client's business risk, identify areas with increased risk of material misstatement. So this is the risk assessment process in 315. Now, this is a table out of the book, and we trend analysis or horizontal is where we compare this year to last year to however many years, and that's called horizontal analysis or trend analysis. And then we've got vertical analysis. And with vertical analysis, what we typically do is make everything on the income statement a percent of net sales. So cost of goods sold is 72% of sales, salaries, expenses. So everything is turned into a percent of sales, or if we're on the balance sheet, a percent of total assets. This allows us to compare big companies to small companies. It's called vertical analysis because it goes up and down. Then every ratio you've ever learned. Now, ratios used to be a pain back in the paper and pencil era, but now the computer will spit out ratios faster than you can think them up. So every ratio, and you're looking for something that doesn't seem right. The reasonableness test. Analytical procedures very seldom prove that an account is right or wrong, but is it reasonable? And if it's not reasonable, we need to gather more information about it. Evaluation of financial information by a study of the plausible relationships among financial data and non-financial data. Now we're going to compare the recorded amounts to our expectation of what those amounts should be. So we have to form expectations of what they should be, and then we compare to it. We're in the planning phase of the audit. We perform analytical procedures in the planning phase, in the testing phase, and at the completion as an overall review. However, they're not required in the testing phase. Everybody does them because they're relatively cheap. Auditing standards require us to perform analytical procedures in the planning phase and at the completion of the audit as an overall review. The nature of the analytical procedures in the planning phase and in the completion are very similar. The analytical procedures we perform as substantive tests are a bit different. We want to understand the client's business and industry. How are we going to assess risk of material misstatement? Understanding the client, its environment. Okay, assess the business risk. The business risk of the client is going to change their behavior, and it's going to pass through to us. Think of all the small businesses right now who are in financial distress. Companies in financial distress, more likely to misrepresent in their financial statements. If they've got to show a profit to get that loan, they might stretch it a little bit to show a profit. We want to identify areas with increased risk of material misstatement. Now here's an old, similar to the table we just looked at. It was from a different book. I happen to have it and want to emphasize some things. So here we've got prior year, current year, and change. So we've got horizontal analysis. They also did vertical analysis where they took a percentage of sales. But I want to show what we might observe. So in this case, sales are up 10%. That's good. I'm happy. Cost of goods sold are only up 6.7%. Oh, I'm really happy. Gross margin is up 20%. Wow, that's great. Accounts receivable are up from 500 to 900, 80%. Allowance for doubtful accounts is up 25%. Now, cash is way down. That may or may not bother me, what they use it for. And here they paid down a big bank loan that year. So I want to see what they used that cash for. I don't want to say that decrease is trivial, but there may be good explanations. It doesn't bother me that there's less cash on hand if there's good reasons. But I want to get back to, if sales are up 10%, how much would I expect accounts receivable to be up? Why is accounts receivable up so much more than sales? Now, I'm thinking about how I could increase sales. So if I'm a car dealer, how can I increase sales? Oh, I can do some great marketing. I can do, but in the end run, one of the things I can do is drop my price. But they didn't drop their price because the gross margin is higher. So that means if anything, they raised their price. They didn't drop it. So sales are up 10%. They didn't drop their price. Maybe it's a booming economy. Maybe it's a booming economy. But why did the people borrow money to buy their cars instead of paying cash? I don't know, but these all things have to be answered, because another way to increase sales is to lower your credit standards. So when we look at the financial problems in the housing market in 2008 and 9, one of the things that happened to some degree was banks lowered their credit standards. And when they lowered their credit standards, more people could buy houses. But if they lowered their credit standards, then wouldn't we want our allowance for doubtful accounts to increase even more? So if they lowered their credit standards, I'd want the allowance for doubtful accounts to increase at least as much as accounts receivable increased, and in reality, more. Now, when I do ratios, I get the same thing. So day sales and receivables is way up. It's up 67%. Doubtful accounts ratio is down. Oh, wow. Receivables turnover is down. Now, I really need to look into how they increased their sales, why accounts receivable are up so much, and why the allowance for doubtful accounts as a percentage of accounts receivable is down. So this doesn't answer any questions, but it doesn't seem reasonable, and it raises questions that I'm going to look into more deeply To me, these are areas with an increased risk of material misstatement. I'm still in the planning phase. Now notice, auditors are supposed to develop expectations. Well, notice we're going to compare the recorded amount with our expectations. Now what I just did is not adequate. I should go through industry averages and how much on average did sales go up in car dealerships, how much did bad debt expense go up. So I should do some research beforehand so I can make predictions of how much I think sales should have gone up, how much I believe accounts receivable should have gone up, what I believe their allowance for doubtful accounts should be. And then I'm going to compare the recorded amounts with my predictions. And if they're different, I'm going to investigate them if they're significantly different. And document. That's something I don't do a good job of, is everything has to be documented. If a company gets sued in 5 years, it's going to be 3, 4, 5 years after the audit when they get sued, and you're probably going to be gone. Most people don't work for the big accounting firms for 5 years before they leave. So it's all got to be well documented. Audit risk. This is a definition I expect you to know for the rest of the quarter. The risk that the auditor expresses an inappropriate opinion when the financial statements are materially misstated. Okay. Materiality, well, that's part of the chapter title, so we better learn that. The magnitude of an omission or misstatement of accounting information that in light of the surrounding circumstances makes it probable that the judgment of a reasonable person relying on the information would have been changed or influenced by the omission or misstatement. I want to emphasize probable. Probable, reasonably possible, and remote are important words to auditors. We record assets when they're probable. Asset is a probable future economic benefit. A liability is a probable future sacrifice of economic resources. So we record things when they're probable, not certain. Then remote means it's not going to happen, and reasonably possible is more likely than remote and less likely than probable. So probable is what I believe is going to happen. Makes it probable. So don't get that wrong. Okay. Performance materiality, tolerable error, tolerable misstatement. I mistakenly use these words interchangeably. So to me, performance materiality, tolerable error, tolerable misstatement are all the same thing. You have to allocate your preliminary judgment of materiality to the account balances and transactions. Okay. So here's the book has materiality, earnings from operation 221. Current assets, that's the materiality 3%, total assets 1%. Current, so they're going to take this number, this 221, and they're going to double it. And they're going to say, wow, if things are off by 420, 442, we got a problem. So then they're going to allocate that out to each of the individual accounts. So this 442 is effectively their definition of materiality, and they're going to allocate it out for their test purposes. This is not quite the same as materiality, but we have to allocate it out to the various accounts so we can design our test. We can design our test so to make sure that they would uncover a error if accounts receivable are off by more than 265. Class of transaction, credit sales. We put credit sales together with cash receipts, and we get the revenue and collection cycle. In your statistics class, the larger your sample, it increases. Whoa, the larger your sample, that's terrible wording. The larger your sample, the more confident you are in your conclusion. So in statistics, we talk about confidence. And the larger your sample size, the more confident you are in your conclusion. Similarly, the more audit evidence you obtain, the more confident you can be in your conclusion that the financial statements are fairly presented or that accounts receivable are fairly presented. If the evidence is appropriate and relevant, it has to be appropriate and relevant. In statistics, you might have used the word representative of the population. So we want to make sure that our audit evidence is representative of the population. And we say if it is, we say it's appropriate and relevant. There's a great little table in the book. I can't think of what page it is. I'm hoping it shows up here. We're going to look at inventory. Performance materiality is $36,000. The projected misstatement's $31,500. So we took a sample, and then we have to project our sample results to the population as a whole. Now, one of the biggest mistakes students are going to make are going to say, oh gosh, my projected misstatement is less than performance materiality, therefore I'm happy. Maybe, maybe not, because we have to add an allowance for sampling risk. So when you had a confidence interval in statistics or a hypothesis test, there was always the risk that your sample was not representative, and so you had an allowance for sampling risk. When we add the projected misstatement to the allowance for sampling risk, that exceeds performance materiality. Therefore, we're not happy, and we're going to have to gather more information. Okay, we can't say that the account is overstated because our best estimate is that it's not materially overstated. But we're not confident enough that it's not overstated, so we're going to have to obtain more evidence. Now, in this sample, they took a sample of 50,000 out of 450. So the inventory balance was 450. They sampled items totaling 50,000. That's 1 out of 9. And this is on page 251, 252. Now, here's the same problem. Now, when they took their sample, they found a misstatement of $3,500, but they only audited 1/9 of the population. So they have to project that. And the easiest way to project that is to multiply 350 times 9. They took a sample of 50 out of 450. So we can just invert that and make it 450 divided by 50, and that will project the error to the population. So our best estimate is that the population is overstated by 31,500, which is less than performance materiality. But we know whenever we use statistics, there's a possibility that we're going to be wrong, reach the wrong conclusion. So we have an allowance for sampling risk. In this case, it's 15,750. Now, we could use statistics to calculate what that should be. We're not going to in this class, but what I want to point out is the allowance for sampling risk is usually about half of performance materiality. So if I had to guess, and performance materiality was 36,000, if I had to guess without using statistics, I'd say the allowance is probably going to be about 18,000. So this is a big number. If we add these together, it exceeds performance materiality, and I don't have adequate evidence to show that the inventory is not materially overstated. I don't have evidence that it is materially overstated, but I am not nearly confident enough to say it's not materially overstated. Okay, so when I add what happened there? When I add my projected error to the allowance, I get 47,000, which exceeds performance materiality. Well, that wraps up this chapter, and so I will see you tomorrow.